Have you wondered how to get in trades at the high or low of the day? Essentially trading the bottom or the top of a daily candle. If so, then let's get started. Before you proceed, please make sure you like the video. That'll help us continue making these free lessons. So back to the basics. When looking at a candle, you have a candle open, a candle high or low, and a candle close. So now let's talk about the daily candle, how it's formed on the intraday, and the concept of a candle flip. So here you have your daily open. The opening drive was bullish, price makes the high of the day, and you have a reversal. And here you have your candle flip. A candle flip is when price gets below the opening price. Price makes the low of the day and closes right above the low of the day. And the intraday delivery could manifest itself in multiple profiles. So let's talk about the catalyst. The catalyst is the factor that starts or kicks off the entire move. In other words, an initiator, where the bulk of institutional orders are injected. For this entry model, our catalyst will be the daily extreme supply and demand zones. Here we have an example. Price broke structure and retraced back inside the range to head for that extreme supply zone. And regardless of the time frame, price often respects these supply and demand extreme zones. So your question might be, what makes this supply an extreme supply zone? What makes it extreme is the fact that it's located at the top quarter of the range. So the top quarter would be your supply and the bottom quarter will be your demand. So to tie things up, if we go back and reference the first example of this lesson, you will see that that daily flip was caused by an extreme supply, which was our catalyst. So now let's add an additional layer. What we want to see is for price to absorb daily liquidity, specifically external liquidity. So if you're going bearish, you'd want to see price absorb the previous day's high. If you're going bullish, you'd want to see price absorb the previous day's low. So what you have here is price closed at your catalyst. So what you're looking for is for price to absorb that liquidity right above, which would be the high of the day. The takeaway from this is since we are in a supply zone and basically we are going bearish, you're looking for that daily liquidity to be a bullish day. And the same concept inverted. So if you're going bullish, if price is approaching a demand zone or at a demand zone, what you're looking for is that bearish day, and your daily liquidity would be that bearish day's low. So now let's talk about entries. So for this strategy, you have two types of entries. You have your reversal entry and your continuation entry. The continuation entry we're going to use for this strategy will be the daily candle flip. We would wait for price to absorb the previous day's liquidity, then get below or above the current day open. You enter once price gets below or above the daily candles open, with your stop loss being placed at the current day high or low. A reversal entry for this strategy will be price testing the current day's high or low post liquidity absorption. Once price absorbs that daily liquidity and drives in the opposite direction, you would wait for a retest of that extreme supply or demand zone on the micro timeframes. So here's your catalyst, and let's mark our daily liquidity. So we have our bullish candle. Again, if this was a bearish candle, this would nullify the trade. This would no longer be an active trade. This has to be a bullish day. So now let's go on the intraday. So this is our current day open. Remember, the liquidity is right here. And this is the current day open. So what are we waiting for? We're waiting for price to sweep liquidity. We're waiting for that liquidity to be swept. And once price sweeps that liquidity, it's either we're looking for a flip for price to get below this level or price to test the high. So continuation or reversal. Price swept the liquidity, and once price swept the liquidity, came below our open. So this will be our stop loss. Our first take profit would be this extreme zone right here. Now, sure, this was a flip entry, but what happened here? Let's delete this for a better view. Price absorbed that liquidity, made the high, dropped down, and came back and tested that high again. So if you pull out a micro fib right here, price tested your micro supply. This would be your micro supply. And if you are trading reversals, this would be your entry. So here we have our catalyst. And as a reminder, price doesn't need to make contact with your catalyst every single time. Your catalyst could be right here and just price simply being near the area. Most important, below the 50%. So this will be the 50% of the range. If price is below that 50%, price is already in discounted zone, and vice versa, price would be in premium. So keep that in mind. Let's mark our liquidity, our daily liquidity. And now let's go on the intraday. So what are we waiting for? This new day starts. We're waiting for price to absorb this liquidity and flip back above the current day's open. So this will be our current day's open. And once price sweeps this liquidity and gets above the daily open, we are in the trade. So what happened here? Price swept that liquidity. Once price swept that liquidity, you wait for price to get above your daily open. Your stop loss would be at the current day low, and your take profit would be at the extreme. So at the extreme of the micro, you would pull out your fib. And this would be your ideal target. And why do we take profit at extremes? Because even though this is a micro level, price could always reverse from these extreme supply zones, these counter orders. So what you will encounter when it comes to these entry models is at times one of them works and the other one doesn't, and vice versa. And at times both of them work and other times both of them don't work. And we're going to really break this down when it comes to statistics and data. But look at this example. What we have is we have our catalyst, we have our motive, which is going bullish, and we have our bearish candle, our bearish day, and we have our liquidity, which would be this day's low. So now let's go on the micro. And the next day should start now. So this will be the daily low. So now price grabs that liquidity. Where's our daily open? Our daily open is right here, where the bullish candle opened. Actually, let's zoom in. So this was our liquidity. This is the daily open. And for a flip, you're waiting for price to get above this zone. So now, what do you have here? You have that aggressive swing to the upside. So now you have a micro demand zone. So this will be a retest of the high, of the low, excuse me. This will be a retest of the low. So this would be our reversal entry. As you can see, our reversal entry failed. But what do we have here? Price got above our daily open. So now our stop loss is the daily low. And our continuation entry worked. So this is an example of when it comes to picking between your entry models. At times, if you're trading both of them, which we do have the statistics on, at times one of them won't work, but the other one will work. And this is why we advise for you to pick one of them. And we'll get to this in our next chapter. So here we have the statistics for AUD/USD from June 2019 all the way to June 2020. And we do have stats that go all the way up to 2024, but in this lesson, we're just going to cover 1 year. So the main thing we kept track of was the trend, the entry model, and the risk to reward. Here you have your reversal trades. So this is basically your M's and W's. And here's your continuation, which is your flips. And something that should instantly jump out is the amount of attempts. So the amount of attempts in a year, when it comes to your reversal trade, you had 30 attempts. When it comes to your continuation trade, which is your candle flip, you only had 22 attempts. So your reversal will present itself more. So where we have non-applicable is when price does not give us at least one R. So if we get a negative R, that would be non-applicable because by that time you would move your stop loss if it's above 0.5 R. So above 0.5 R would be considered non-applicable. Anything below 0.5 R, since you don't have time to move your stop loss, will be considered as a loss. What was also pretty interesting was when you get the same setup twice in 1 day. So usually you could get two different entry models in the same day. Because at times when the candle does flip, you do get a chance to enter earlier at a reversal. But in some cases, you get the exact same entry twice in one day, and one loss, one win, and it ends up breaking at break even. Usually, it's in a very interesting way. It's the exact same amount. So if your loss was 20 points, a lot of times on the second attempt you get the exact 20 points back, and you end up breaking even. And it happened twice. So it happened in July, and it happened in April. So for an example of this, look no further than one of our previous examples. So what you have here is your flip. Now let's go on our intraday. Let's mark up our opening price. Where did the daily open? The daily opened right here. And let's make this black. And obviously this would be our liquidity, the previous day. So this previous day was our liquidity. So what happened here was price opened up here, absorbed the liquidity, went for a flip, failed at the flip, grabbed more liquidity, and then completely flipped. So this is what I mean by your multiple setups of the exact same setup pair day. So you had two flips in this one specific day, and they usually cancel each other out. So let's say you were going short right here. You're going short at this flip right here. This would have been your loss. So you would have been negative 20 points. And then you had another chance for a flip where you gained around 40 points. So actually in this case, you came up with a positive 1R, but usually they do cancel each other out. So if you would take a 20-point loss here, on the second flip, you would take a 20-point win. So this is what I mean by they usually cancel each other out. Obviously not in this example. So there's a lot more when it comes to data and statistics, especially if you accumulate 3, 4, 5 years worth of data. And if you are interested in learning more, make sure you visit our website, enroll in ETM Concepts Deluxe, and use code DISCOUNT for 20% off. So to conclude the data, if you do trade every single setup, which is you take your flip entries and your reversal entries, you would be at a 69.23%. If you strictly trade retests, you would be at a 63.33%. Now, if you trade strictly flips, you would be at 77.27%. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and let us know in the comments what lesson do you guys want next.